You're sitting at the kitchen table with your partner. It's Sunday night. The house you want just hit the market 3 days ago. The agent says there are already 6 other offers, maybe more by Monday. You've been looking for 8 months. Every house that felt right got snatched up before you could even schedule a second showing. This one has the yard, the light, the school district. It feels like the one. Your partner looks at you and says, "What if we go 20,000 over asking, just to be safe?" You hesitate, then you nod. And in that moment, you make a decision that will cost you more than the down payment you saved for 3 years. Not because you overpaid for the house, but because you won.
When you win a bidding war, you don't just pay more than you planned. You pay more than everyone else was willing to pay. That's not the same thing. The difference between those two numbers is called the winner's curse, and it doesn't show up on your closing documents. It shows up in your bank account over the next 7 years. Here's what most people don't calculate. Every dollar you spend above fair value doesn't just cost you that dollar. It costs you the opportunity cost of that dollar, the mortgage interest on that dollar, the insurance and property tax on the inflated assessed value, and the equity you'll never recover when you sell. But more than that, it changes the math on every other financial decision you make for the next decade. You're not unaware of this because you're bad at math. You're unaware because no one is sitting across from you during the offer, showing you the calculator.
My name is Jimmy, and I spend way too much time thinking about the invisible cost of being right. If that sounds like the kind of thing you worry about at 2 a.m., you should probably subscribe. Here's the model. Winning price equals fair value plus overpayment plus winner's curse penalty. Fair value is what the house is actually worth based on comps, condition, and market. Overpayment is how much you bid above that to compete. Winner's curse penalty is the hidden cost of being the highest bidder. It's the amount you paid beyond what the second highest bidder was willing to pay. That's pure loss. No one else thought it was worth that much. Most people think winning a bidding war means they got the house. What it actually means is they were the only person willing to lose that much. Let me say it again. The winner's curse penalty is the gap between what you paid and what the next person was willing to pay. That gap is your mistake, priced in dollars.
Let's use real numbers. You find a house listed at $650,000. Based on comparable sales in the last 90 days, fair value is around $640,000. The market is hot. You know you'll need to go over asking. You submit an offer at $680,000. You win. Here's what just happened. You paid $40,000 over fair value. But let's say the second highest offer was $665,000. That means your winner's curse penalty is $15,000. That's the amount you paid that no other rational buyer thought was justified. Now, let's track that $15,000 over 7 years, the average amount of time people stay in a home before selling. You financed it at 7% interest. That $15,000 costs you an additional $1,050 per year in mortgage interest. Over 7 years, that's $7,350 in interest alone. Property taxes are around 1.2% in most markets. That $15,000 in inflated value costs you $180 per year. Over 7 years, that's $1,260. Home insurance is roughly 0.5% of home value. That $15,000 costs you $75 per year. Over 7 years, that's $525. You're already at $9,135 in direct costs from the winner's curse penalty. But it gets worse. When you sell in 7 years, let's assume normal appreciation of 3% per year. Your $640,000 house is now worth around $786,000, but you paid $680,000, which means you paid $40,000 over fair value at purchase. With appreciation, fair value at sale is $786,000. Your sale price will likely be close to that because the market doesn't care what you paid, it cares what the house is worth. That means the $40,000 you overpaid never turns into equity, it vanishes. But wait, let's add opportunity cost. That $40,000, if invested in a standard index fund at 10% annual return, would be worth $77,000 after 7 years. So your total loss is $40,000 in unrecoverable overpayment, $9,135 in carrying costs, $37,000 in foregone investment returns. That's $86,135. And we haven't even talked about the down payment. If you put 20% down, that $40,000 overpayment required an extra $8,000 in cash up front. That $8,000 invested at 10% would have been worth $15,600 in 7 years. Your total cost of winning the bidding war, $101,735. Let me repeat that. Winning cost you over $100,000, and none of it showed up in the purchase price.
Once you see this, you can't unsee it. Bidding wars stop feeling like competition. They start feeling like auctions where the prize is the right to lose money. The advice you've been given your whole life is, don't let the perfect house slip away. But that advice assumes the house has intrinsic value to you beyond money. It assumes your happiness is worth the premium. And maybe it is, but now you know the price of that happiness, and you know it's not the number on the offer. It's the $100,000 you won't have in 7 years. The shift is this. You stop asking, can we afford the house? You start asking, can we afford to win?
Here's who benefits when you don't do this math. Your real estate agent. They get paid a percentage of the sale price. The higher your bid, the higher their commission. They have no incentive to tell you that you're overpaying. In fact, they have a direct financial incentive to encourage you to bid higher. The seller's agent. Same story. They want the highest price possible. The mortgage lender. A bigger loan means more interest income. They don't care if you overpay. They care that you qualify. The appraiser. In a hot market, appraisals often come in at the offer price because banks want the deal to close. The entire system is designed to confirm your decision, not question it. No one in the transaction is paid to protect you from the winner's curse. No one is holding up a calculator and saying, this will cost you $100,000 over 7 years. The system is designed to get you to the closing table, not to get you to wealth. Stop measuring houses by price. Start measuring them by freedom cost. Freedom cost is how much longer you'll have to work to pay for the decision. Let's go back to the $40,000 overpayment. If your household saves $15,000 per year after tax, that $40,000 represents 2 years and 8 months of work. That's not the price of the house. That's the price of winning. 2 years and 8 months of your life. Now ask yourself, would you work an extra 2 years and 8 months to win a bidding war? Most people wouldn't, but they do it anyway, because they're not measuring in time, they're measuring in dollars. And dollars don't feel like years until you convert them. Here's the reframe. Every financial decision is a time decision. The question is never, can I afford this? The question is always, how much of my life does this cost?
Here are 5 experiments you can run the next time you're in a bidding war. 1. Before you submit an offer, write down the fair value based on comps, not the list price, fair value. Then write down the maximum you're willing to pay. The difference is your overpayment. Multiply it by 7. That's your minimum 7-year cost. Decide if you're willing to pay it. 2. Ask your agent, what do you think the second highest offer will be? Then bid exactly that or walk away. You don't need to win, you need to not lose. 3. Calculate your freedom cost. Take the overpayment and divide it by your annual savings rate. That's how many extra years you'll work. Write it down, show it to your partner, say it out loud. 4. Set a walkaway number before you see the house, not after you fall in love with the kitchen, before. Write it on a piece of paper and put it in your pocket. When you're tempted to bid higher, take it out and read it. 5. If you lose the bidding war, celebrate. You just saved $100,000. Take your partner out to dinner with the money you didn't spend, because losing is winning.
You're sitting at the kitchen table with your partner. It's Sunday night, The house you wanted just went under contract. Someone else bid higher. You feel disappointed, maybe even a little angry. But then you remember the math. You remember that the winner didn't just buy a house. They bought 2 extra years of work. They bought $100,000 in invisible costs. They bought the right to lose. And you remember something else. There will be another house, but there won't be another 7 years. You lost the house, but you won your time.
The game is rigged, but at least now you know the rules. Subscribe if you want to stop playing by them. Comment below, what trap hit closest to home?